Hi, Doug Carlson here again. Today I'm going to talk about investing, my favorite subject. It's going to be really fun. Wanted to tell you that this brick background is actually in my sunroom. This used to be the outside of the home I live in Denver. It's in an older neighborhood, big trees and really fine. Because of that, we don't get a whole lot of ambient sound. Yeah, there are some dogs in the neighborhood. As long as they're very quiet, there's not a problem, and the air conditioner may come off and on, but that's not enough to stop me normally. Well, today again, we're going to talk about investing. I'm going to keep it short, quick, and hopefully fun for you guys. First of all, the disclaimer. Any show that you ever watch or you listen to will always at some point say the following is not to be construed as financial advice. It's for educational terms and purposes only. Please consult with your advisor before making any financial decisions. And then they go on for the next hour to tell you exactly what you should buy, what you shouldn't buy, when to buy it, and so forth. Well, you guys are dentists. You're going to decide what you want to do anyway, no matter what I say. But I would like to tell you how I've done it and how the academics say to do it. Let's get started. First of all, most planners will say asset allocation is the most important part of financial planning and investing. Well, I tend to disagree. It's important, and we'll get into it in just a second, but savings is the most important. How much you save per year is much more important than what kind of assets you buy. 15% per year of your net income is the magic number for dentists. 15%. If you can save that much from age 35 on, you're going to retire by your early 60s, or have enough money to retire by your early 60s. 20% is the holy grail. If you can do that, you'll be in good stead by age 55 to 60. Well, let's talk about asset allocation. All the academic research shows that you need to be in the whole market at all times. Well, what's the whole market? Stocks, first of all. Large cap, small cap, growth, value, international. Get into everything. Fixed income. That's bonds primarily. Treasuries, corporate bonds, high yield or junk bonds. Own everything, the whole market. That works best over the long run. Let's talk about risk a little bit. That's a very important part and gets complicated. There's about 10 different areas of risk that we could talk about. I'm going to talk about just the ratio between fixed income and stocks. The more stocks you have, the more risk you have. 80-20 percentage of 80-20 ratio of stocks to fixed income is going to be a lot riskier than a 50-50 ratio of fixed income to stocks. And fixed income is normally bonds that we talk about. So that's one way of looking at risk. I want to let you know, though, that most of us have a lower risk tolerance than we think we do. This was shown really well in my article about neurofinance in Dentaltown a couple months ago. We have a lower risk tolerance than we think we do. Well, say you go to a financial planner. One of the first things they're going to ask you is, what's your risk level? In other words, what's the most loss you could handle psychologically in a year? 10%? Yeah, I could handle 10%. That'd be okay. What about 20%? If the markets went down 20 and your portfolio was off 20%, could you handle that? Yeah, I think so. What about 40%? Nah, I don't think so. Well, what happened in 2008 is a lot of people bailed out of the market when the S&P went way south of 20%. In fact, it was more than 40% at one point. A lot of people bailed on that 40%. A lot of people had decent allocations and had bonds in their portfolio and lost 20%, and they bailed out. So be very careful of what your risk level is. Have that evaluated closely if you are going to go to a financial planner. Otherwise, what I'm going to talk about as far as funds below have relatively low risk levels. Well, let's talk about market timing and active management a little bit. Market timing is talked about a lot over the airwaves today. You need to be in the market at a certain point. You need to know when to get out and when to get in. And I know how to do it. I've had experience. I've done extremely well over the years, and they'll never give you any documentation of how they've done. Market timing is anathema to academic research. It does not work. You need to be in the market at all times, especially in retirement. When you're withdrawing funds, you need to stay in it. Let's talk a little bit about active management. That gets into market timing in some way, shape, and forms. But there's a lot of talk about sector or asset class rotation. In other words, we may be in the market the full time, but this year, because of the Supreme Court decision, healthcare is going to do better for the next couple of years. We're sure of that. So we're going to put more money into healthcare. Oil's been weak. We're going to stay out of that. Doesn't work. Active management does not perform passive management regardless of what the fees are in any study academically done. Bottom line here for the first part, stay in the whole market, use passive investment strategies. What are passive investment strategies? Index funds, either ETFs or mutual funds. They're basically the same. The difference between an ETF and a mutual fund is ETFs can be traded during the day. Mutual funds, you always trade at the end of the day, and pricing is done at the end. Well, for buy and hold, what's it matter? We want you to buy and hold. That's what the academic people say. I say we. You make your decision on that, but the academic evidence is out there that buy and hold works best over the long run. I'm going to talk about two different types of an easy way to use buy and hold passive investing today that have worked well over the last 10 years. First one are called lazy portfolios. There are about 8 of them total. They have anywhere from 3 to 12 funds. I'm going to show you one today. It's called Coffee House. It has 3 funds. Really simple. 1/3 are in Vanguard Total Bond Index funds, 1/3 into Vanguard Total Stock Index funds, and 1/3 into Vanguard Total International. Covers the whole market. It has an expense ratio of 0.19%. Really low. Why do we use Vanguard? Why am I talking about Vanguard? Because their expense ratios are lower than Schwab or T. Rowe Price or Fidelity. Those have really good index funds too that are very similar to Vanguard's, but the expenses are higher. You might as well go with Vanguard. Think about lazy portfolios. The only thing you have to do is rebalance once a year. And rebalancing on something with 3 funds is very simple. Well, what's rebalancing? Take a 50-50 mix of 2 funds. One's a bond fund, one's a stock fund. You start out at 50-50. Say at the end of the year, stocks have done great. Bonds haven't done so well. Now your ratio is 60-40. You got 60% stocks, 40% bonds. What do you do to rebalance? You sell some of your stocks and buy more bonds to get back to your 50-50 ratio, which is where your risk level is. Well, some people would say, well, the stocks have done better. Why in the heck, why would you sell them and buy bonds that haven't done so well? You never know what's going to happen in the future. Take some profits from the stocks and buy bonds cheaper. Rebalancing works extremely well. That's all you have to do with lazy portfolios. I've been in them since 2005 and have done fantastic. Another way to invest easily where you don't have to rebalance is using target date funds. Now, target date funds have taken a hit from a lot of financial planners because they lost 20% back in 2008. Well, a lot of us lost 40%. They were only down 20 because they had a lot of bond exposure. Some people freaked out, and financial planners freaked out and went, wow, this isn't working, especially if you're going to retire in the next couple years. Well, guess what? Within a couple years, we were back to even, back to normal. You're only taking 4% withdrawals per year. How much are you going to lose? Target date funds work extremely well. They're very easy. There's nothing to do. You just pour money into them. They'll rebalance on their own. Now, there's different target dates. And supposedly, you pick the date about when you're going to retire, and the target fund will gradually become more conservative, more with bonds, less with stocks over a period of time. Now, your target date of your actual retirement may not work for you. In fact, a lot of people say you want to retire in 2040. You buy the 2040 fund, that's like 90% stocks. Maybe you're more conservative, more risk adverse. So you buy a 2020 fund and hang on to that forever. That works. Well, here we've got listed the 2020 fund, which has an expense ratio of 0.18%, quite a bit less than Schwab, T. Rowe Price, or Fidelity. That's why I'm talking about Vanguard funds. In the next few years it may change. The others may get less expensive. That's fine. They basically are plain vanilla, all of them. 2020 fund is 45% total stock market index, 19% total international, and 36% total bond. Vanguard index funds, just like we were talking about above. Now this has 45 and 19, 64% stocks and 36% bonds. Even that may be too aggressive for you, so you go to a 2015 fund. Whatever you like works well. Another thing about index funds is they're the most tax-efficient way of investing. There's not a whole lot of buying and selling. Any dividends that are given off are also done tax efficiently. Now this is important in an after-tax or cash fund. Definitely not in tax deferred. Well, let's talk about certified financial planners. I've recommended them in the past. And Carlson, are you telling me that certified financial planners aren't proper? Yeah, they are. They're very important for figuring out insurance strategies, handling of debt, estate planning in particular. But to pay a 1% wrap fee for financial planning when you can do it on your own and do just as well with index funds may not make a whole lot of sense. So if you're working with a certified financial planner and they're charging maybe 0.5% to handle your investments, that may be okay, but I think 1% is very high. Also, if they're using active management, be careful. Active management does not do as well as passive. Well, the other remark I get from people is, well, this is boring, Carlson. I mean, I just throw money into a target fund or one of these lazy portfolios every now and then, monthly, and that's it. I may have to rebalance or do something once a year, and otherwise, I don't really look at my investments. This is what John Bogle says, the founder of Vanguard. He gives a lot of advice and is a very smart man. He says, don't look at your portfolio that often. You're going to mess around with it and ruin it if you do. But this is boring. I want to do something on my own. I know I can do better. Use the 5% rule. 5% is called play money. 10% I think is too high. Some recommend 10. I think 5 works well. In other words, if you have a $500,000 portfolio, $25,000, 5%, use it as play money. You can invest in oil. You can invest in real estate LLCs. You can get into gold, BlackRock hedge funds. You can get involved with them if you want. If you lose it all, it doesn't matter. 5% or 25,000 out of 500,000 is certainly okay for play money. Say you double it. Say it goes from 25,000 to 50,000 within a couple weeks or a couple years. What do you do with that? Take away. Usually a doubling is a good way of stopping and selling. If it doubles, take it all away. Take your $25,000 profit, go buy a Harley. It doesn't matter. You can reinvest it into your real core portfolio, but you can also spend it on something frivolous. It's play money. Well, what if you lose everything? You go from $25,000 down to nothing. What do you do then? Then you wait until your regular portfolio gains $25,000 again to start up. It's an easy way to get involved with technical analysis, say, or fundamental analysis, and doing things on your own. But please don't use more than 5%. Otherwise, indexing is the way to go. I'm going to have a book list here of what I think really will help you understand investment and know what really works and what doesn't. Again, this is taken from how I've invested, what I've learned that the academic researchers have come up with, and how dentists that have been able to retire early or build real wealth early, how they've done it. Thanks so much for listening today. I know I'm going to get phone calls and emails on this, so have at it. Go after me. Anything, criticism, plus or minus, good or bad, is certainly welcome. I love doing this. Have a great day.